Hello, my name is ZDavis, and I am presenting Abercrombie and Fitch in their financial analysis for Accounting 502 at Grand Canyon University. Major sources of cash per cash flow section. The operating activities section, the major sources of cash on the provided statement of cash flows for their fiscal year 2022 are in the net income section of $10 million and the depreciation and amortization section for $132 million. Under the investing activities, major sources of cash in that section of the cash flow statement are the proceeds from the sale of property and equipment for $11 million and the withdrawal of funds from the Rabbi Trust assets for $12 million. Financing activities for the fiscal year 2022, Abercrombie and Fitch did not receive payment under any sections of the financing activities, but they did spend $125 million in purchasing common stock, and they spent $7 million on purchases of senior secured notes, which we're going to go over that stuff a little more in later slides. On this slide, you can see that it is the cash flow statement from the 10K provided by Abercrombie and Fitch, and they have the years listed for 2020, 2021, and 2022. Major uses of cash per cash flow section. Under the operating activities, the largest use of funds in the operating activities is towards the accounts payable and the accrued expenses for $115 million. Increases in accrued expenses and accounts payable are shown with the negative signs in front of the cash flow statement since they cause cash to decline. That's from the Wall Street Prep. The other large use of money in the operating activities is the $86 million used in other assets. Changes in other current assets can have positive cash flow impact if they decrease from one period to the next, or a negative cash flow impact if they increase from one period to the next. And that's from O'Reilly. From the notes of the 10K, other assets are listed as such. Other assets on the consolidated balance sheets consist primarily of the company's trust-owned life insurance policies held in the irrevocable Rabbi Trust, deferred tax assets, long-term deposits, intellectual property, long-term restricted cash and equivalents, long-term supplies, and various other assets. Under investing activities, purchases of property of equipment is a total of over $164 million, and financing activities, as mentioned in the previous slides, portions show $125 million on purchasing common stock, and they spent $7 million on purchasing of senior secured notes. So each of those ideally would pay back in the future. For the investing activities, the $164 million, again, investing, so hopefully that can make them money in the future. And the operating activities for the other assets, as the notes explain, the other assets is the trust-owned life insurance policies and irrevocable Rabbi Trust. So again, that sounds like investments for the future. This slide is net income versus cash used by the operating section. The net income for fiscal year 2022 for Abercrombie and Fitch is $10 million, a little over $10 million. For comparison, 2021 it was $270 million. For 2020 it was negative $108 million. Their net income for these 3 years is not consistent. It's just all over the place. A big part of this was from COVID, and also Abercrombie and Fitch started a looking forward program to grow their company, and they were doing some different investing type stuff. 2022 had net income of over $10 million. The net cash used for operating activities totaled at $2 million, a little over $2 million. The major difference between the two values could be found by looking at the income statement in addition to the cash flow statement. There you can see the actual income attributed to Abercrombie & Fitch was $2 million, a little less than $3 million, much closer to the cost of operating activities. One other aspect is that for 2022, Abercrombie & Fitch used $115 million to pay off accounts payable, whereas in years previous, this number was positive. Adjustments to net income need to be reported because, as the textbook explains, the reconciliation of the accrual-based profit figure, net income, in CFFO begins with the adding back of depreciation and amortization. These expenses are added back to net income because they did not result in a cash outlay. For the same reason, increases in provisions are added back to net income while reductions are subtracted. Just reporting net income without any adjustments does not give a clear enough picture of how a company is doing. Financial strengths and weaknesses for Abercrombie & Fitch. Reading through the MD&A, it explains that COVID negatively impacted the company, and in the years following that, the inflation rate has gone up and caused an increase in cost of materials, like cotton, for instance. They mentioned that they are not sure if consumers' income will match inflation, that the success of their business is reliant on people being able to afford their products. Also, they were having supply chain issues due to factory closures in Vietnam. Just looking at the end period of cash for the company over the last 3 years, in 2020 it was $1.1 billion. In 2021 it was $834 million, and in 2022 it was down to $527 million, so less than half of what it had had 2 years prior. Abercrombie & Fitch took a hard hit with COVID and had to close down stores overseas. They closed 16 international stores but were able to open 13 others. In the USA, they opened 46 new stores and had to close 10 others. So growth-wise, they look pretty good on that aspect other than overseas, but really looking at the current year, 2023, would be the best picture overall to see how the company's doing, to see if they're actually like recovering from COVID or not. Abercrombie & Fitch is trying to bolster their online presence and open up smaller, more economical stores to help save on PP&E costs. Overall, I think that the future of Abercrombie & Fitch and all clothing and apparel companies like them is dependent on the people that shop there. The companies would be able to keep themselves alive through investing for a while, but at the end of the day, they need to sell their products. If people's income can keep up with inflation, then they will keep buying those products. If not, then those companies will be struggling. In my opinion, Abercrombie & Fitch would not make a wise investment due to increasing inflation in our country at this time. According to bankrate.com, current Fed funds rate is 5.5%. Last year it was 4%, so it's quite a bit higher. Continuing on with the financial weaknesses versus strengths, we talk about the use of money in the operating activities, the $86 million, which was mentioned earlier, and also the $164 million on PP&E for Abercrombie & Fitch. So, they're making investments for the future. They're trying to look forward. They're trying to build. They have a plan to build. And as I was saying, although I would not promote investing in this company at this time, they might be a good investment because of their future plans of growth. If they make it through this current year and next year or the year after, and then interest rates, the Fed funds rate comes down and people's income matches the cost of living more, people start buying more clothes, they start buying more nice clothes. I mean, Abercrombie & Fitch could just explode. Their stock could explode. So, it could actually be a good investment. It's just that this year it doesn't look good, especially when you look back the last 2 years and they're kind of financially, it appears that they're going downhill. But they could still be a good investment and they could still recover.